never slow up, no I don't take shit. I got no love for the fakeness. If you wanna play tough and wanna hate this, I'll always show up and make a statement. I don't ever slow up, no I don't take shit. I got no love for the fakeness. If you wanna play tough and wanna hate this, I'll always show up and make a statement. I don't ever slow up, no I don't take shit. I got no love for the fakeness. If you wanna play tough and wanna hate this, I'll always show up.
And then we now went to advanced treasury management. That's where we went to asset liability management, one of the main functions of a treasury department of a country's reserve or commercial bank. But to see the exact the in-depth asset liability management strategies, for example, gap analysis, duration analysis, and then we are able to even simulate worst case scenarios during our stress testing to be able to see, for example, during gap analysis, where it measures a country's an asset liability mismatch, especially the difference between risk sensitive assets and liabilities of a bank's balance sheet. And also we're able to do duration analysis where there is a in the time, for example, of entering into a transaction and the point at which the transaction needs to be settled or finalized, that there could be a gap, and that gap is called duration analysis, and it could lead to some risk. And then we're able to, for example, in each case of gap analysis, both in the mismatches in the values of the rates of the rate sensitive assets and liabilities, we're able to simulate some worst case scenarios during a stress testing. And now, for example, to evaluate if that particular bank was resilient enough to withstand such a worst case scenario, especially during extreme conditions, during global financial crisis, during political crisis, during liquidity crisis in a country, during economic downtimes and general economic distress that may face a bank's operating environment. We're able to now even the interest rate sensitivities and the LM strategies now that such banks or the treasury departments of such banks can put in place. We are then able to now look at interest rate risk management. You remember in details, we're able to see how to identify such interest rate risks, and also put down, we're able to see in each case what hedging tools can be used. For example, interest rate swaps, interest rate caps, and also both ceilings and floors, and also to now put these strategies and how a treasury department can put down these strategies to ensure that they stabilize their cash flows, because the banks are stabling. We're able to even yesterday we saw how if a bank is supposed to be receiving some interest rate payments, but due to interest rate risk, there could be fluctuations in the interest rate. Sometimes it can be higher, sometimes it can be lower, and that can lead to unstable cash flows. But then, so now we were able to see, for example, appropriate hedging strategies. In this case, a treasury department or a treasury manager can put in place that stress also that cash flow is stabilized. We're able to even see also in this case if there was a worst case scenario, for example, during stress testing or scenario analysis or sensitivity analysis, if such a bank is able to withstand or put in place measures or frameworks to withstand such worst case scenarios, and how even there is a Basel III requirement regarding, for example, the interest risk mitigation strategies. For example, also in the reporting, and also the Basel III, we said that it also requires it as a requirement and a component that banks are supposed to monitor the IRRB, that is the interest rate in their banking books, IRRBB. Okay. We designed, for example, we looked at a hypothetical situation. We're able to design a hedging strategy on each case of a worst case scenario. What now a treasury manager or the treasury department of a reserve or central bank may be able to do, for example, in putting up interest rate swaps and also options and also futures contracts. We're able to see now. Next, we went to currency and forex risk, and we saw this was special because it mainly forces banks that have international, especially banks that have international subsidiaries. In this case, we are able to see how forex risk, due to the currency fluctuations and also the discrepancies between the currency values of one country and another, can affect a bank's balance sheet, especially banks that hold foreign dominated assets and liabilities. But in each case, we're able to see the appropriate hedging strategies that a bank can use to hedge themselves against such currency and forex fluctuations and volatilities. For example, we're able to see how to use forward swaps and options in each case to stabilize or risk mitigate or hedge against the exposure to such risk, such forex risk fluctuations. Also, for example, we were able to see how a bank can diversify their currency holdings or their foreign currency holdings, especially, for example, to not just invest in one currency or a few currencies, but to diversify across different currencies and portfolio. And that also even lead to arbitrage opportunities that banks and traders, for example, treasury managers can exploit to make profit. And from that, we can even be able to see, for example, how to rebalance their strategies, what we call natural hedging. In this case, trying to balance, for example, the points at which you receive and make some payments. You receive payments and also make payments. If you are servicing a loan and also even receiving some receipts in terms of interest and principal payments, then you can be able to align or match this to be able to reduce your exposure to such forex risk. We're able to even at length see how to even measure the value at risk, as the value of your, for example, long or short position times the historical volatility as measured times a Z score, to get the value at risk and to know how much value of the long position that you hold is at risk, what we call portfolio at risk or portfolio value, that is portfolio value at risk. And in each case, also we saw how to use the different hedging and risk mitigation strategies on each. And then we were able even to simulate a real world, a real life scenario, for example, the JP Morgan Chase Bank and also even the HSBC Bank in Japan. Remember, we're able to see that. Then, the day before yesterday, we also looked at now, after forex and currency risks, we went now into the in-depth capital adequacy and the regulatory compliance of banks and the reserve banks, treasury departments, how they comply to the capital adequacy, for example, requirements by a country reserve or central bank. We in-depth looked at the ratios, for example, the Basel III ratios that we saw even each three components, all there are four components of the Basel III component requirements. That is the CET1, AT1, and also any Tier 2 requirements. Then we looked at for example, the TCR requirement and also the counter-cyclical buffer requirements, and also even the other that is imposed, especially imposed on banks by a country's reserve or central bank, especially during periods of economic downtimes and economic distress, to discourage, for example, excessive lending, and also an additional percentage, and it's called countercyclical buffering, that is imposed to banks by the country's reserve or commercial bank to discourage them from suffering losses. For example, an additional 2.5% in addition to the 4.5% the risk-weighted assets that they are supposed to already meet in terms of their common equity one requirements, especially during periods of, let's say, their countries is going an inflation or a period of economic distress. We're able to even see, you remember how we were able to see how KCB was able to, KCB Bank, when they even ended up missing out or skipping on their dividend payments. That was one strategy of meeting their capital adequacy requirements by the Central Bank of Kenya in this. So we're able to even see not only KCB but even simulate other worst case scenarios, and even during the global financial crisis, we're able to see a stress test, for example, simulate, for example, when a bank's risk-weighted assets increased from 10 billion to 12 billion. Remember, what did that do to their liquidity ratios and also capital adequacy ratios? For example, their tier one capital requirements, the CET1, the additional tier one, the total capital ratio, and also the counter-cyclical buffering and other ratio requirements by the country's central bank or reserve banks. Next, we now went to treasury risk management yesterday, where we were able to now look at for example, we even tried to build a comprehensive framework of what a country's treasury risk department can do, for example, to identify, also to measure, not just identify, but to measure. But then now, after measuring, and then we now see the appropriate strategies to put into hedging such risk. And also even that can also even be a requirement, even not can, it is a requirement even to imposed by banks by the on banks by the country's reserve bank, for them to even report on their risk exposure and also risk management strategies. We went into each type of risk and even simulated how in each type we can be able to curb, to be able to identify, monitor, curb, and report on our risk monitoring and management, and also mitigation and hedging strategies. For example, liquidity risk. For example, we define what it is, especially when the bank is unable to meet their short-term obligations, such as e.g. when there is a surge in withdrawals, when the bank is unable to meet its short-term obligations, then they, in that case, face a liquidity risk. Also, market risk, we're able to see, for example, when there is a multiple, for example, forex and interest rate fluctuations in the country, there can be a market risk. Market risk basically affects the whole banking or even the whole economy or market. Okay, we're able to see credit risk, for example, when you borrow in the interbank and then you're able to pay. Basically, counterparty defaults on obligations, or even when customers are unable to service their debts. Lastly, we looked at now operational risk. We remember where we said can also even such a risk can also even stem from human errors. For example, when such banks do not put a proper laid down framework or risk, what we call treasury management system, any system to prevent losses from such inadequacies. And then now we saw how a bank, for example, a typical bank can lay down this risk mitigation, for example, even risk culture in an organization, how to enforce the risk culture in the organization. We were able to see how treasury departments need to enforce, for example, training and development, and even incentivization of and regular monitoring and compliance review. For example, the banks also need to, for example, regularly monitor and also review their risk mention, things like that. And then so now we went to now the innovations and also the emerging issues in even hedging, not only hedging but also generally the treasury management field. We're able to see, for example, how to use each of the different types of hedging strategies on the different types of risk that a bank or a treasury department may face. For example, we're able to see how to use interest rate swaps where possible, currency swaps and options where possible, futures contracts where possible, and in each type of risk. We're able to even see some real world scenarios. We're able to even do a little bit of stress testing and sensitivity analysis. And then so now and then, that's when we went to yesterday, we went to the in-depth treasury management system. We said that it is any software designed to basically simplify the functions of the treasury department, from capital management to liquidity management, and also risk measurement, and also risk management. I mean, able to see the different types of treasury management systems that banks generally and reserve banks currently use. And also we were able to even see how a typical treasury department can integrate or align their treasury management system and softwares with even other banks or with their country's reserve banks, and even with other enterprise resource planning ERP systems. We're able to see how the importance and features of a typical or an effective treasury management system. It should be able to automate, for example, the treasury management function. For example, if a treasury management functions involve cash flow forecasting, then the treasury management system should be able to that and automate that. Or even report generations, for example, risk management, forecasting, all that can, even in the liquidity ratios, for example, calculation and monitoring of the liquidity ratios and the risk ratios, for example, or risk gaps. A typical treasury system should and usually is able to automate all those processes and into one software, for example, that already even complies with the Basel III and also even the country's reserve or central bank requirements. And basically, we saw how it all automates and eases and simplifies the whole treasury management system system and strategies. We're able to see, for example, a typical in a real world case scenario, if a bank implemented a treasury management system, how, for example, it was able to, for example, minimize their operational inefficiencies, reduce human error, and also even ease in the process of compliance, for example, generation of reports and the risk management frameworks, things like that. We're able to see how a treasury department, a treasury management system, eases the whole process to be able to, for example, comply with the Basel III requirement, because even some central banks and reserve banks already have integrated that system requirement, that appropriate and effective treasury management system, as one even of the additional requirements of bank compliance. And also, for example, in the different functions of a particular reserve bank's functions, for example, on bank supervision. And then we were able to now finally cap the whole unit, now looking at the broader treasury optimization and strategy. We're able to see how to even measure a particular treasury department's risk and strategy effectiveness. For example, using metrics like RAROC, the risk adjusted rate of return on capital, and also to even establish their long-term resilient and also even financial health and profitability. We're able to see how in the long term treasury departments, not only even in the short term, but also even plan for the long term. How they're able to plan and put down appropriate strategies to even expand. We were able to see if a bank was mulling expansion, for example, through an M&A, mergers and acquisition. We were able to see even, for example, a real world example in the case of the National Bank of Malawi acquiring Akiba Commercial Bank, how the Treasury Department was able to come in and was able to simplify the whole process, the strategies and performance optimization strategies that they could to align, for example, the newly formed organization or entity to be able to comply to the and to be able to form the whole three and wide functions of the Treasury Department. And so, in conclusion, we're able to see that this particular training was able to provide us with an understanding, in fact, a deep and in-depth understanding of the Treasury operations, from risk management, optimization, what we call capital management, and basically liquidity management. So it is we even provided hands-on experiences. You even remember how we were pulling up the data of actual companies and their disclosures. We're able to even simulate an hypothetical bank's balance sheet, for example, what their cash and cash equivalents were, their treasury bond holdings were, and for example, and even on the liability side, the equity side, balancing, we're able to see to do stress things, hands-on labs and also hand-on practices. We're able to all see that, and I hope that this space has been able to, for example, provide you with a comprehensive foundation, not even foundation, but an in-depth understanding on the bank treasury management, but both not only strategy but also framework. We're able to see, I hope we're able to see how to even combine theoretical aspects of, for example, treasury management functions with the hands-on practices. We're able to build on treasury operations, risk management, and performance optimization functions of treasury of a country's central bank and treasury department, and you're able to be equipped with skills to be able to even perform even advanced risk management, liquidity management, capital management, basically bank treasury management. Is that okay?
Yes.
Yes.
Okay. So yeah. Okay. Very easy. Just say.